Now we're going to discuss the bullish breaker. So guys, what matters most is for you to know the difference between the bullish breaker and the bearish breaker. The difference of the bullish and the bearish is that on the bearish breaker, we are looking for selling opportunities. On the bullish breaker, we are looking for buying opportunities. So what you just have to know about the market is that on a bullish breaker, that means the confirmation, you don't get the confirmation that you are expecting. The market sometimes can just break and just go down without even giving a confirmation. So it's very much important to understand the difference between the bearish and the bullish. So once the market break down side, just know that the market is going to be selling. Once the market break up, just know that the market is going to be buying. So if the breaker it broke the resistance, the resistance is turned into support. Once the market break the support, it turns into resistance. So once the market breaks support, you'll just have to be looking for selling opportunities. You'll just have to know that once it break the support, the market is going down. It's going lower, and once it's going lower, that means we are going to know that the market will continue going lower. So it is very much important to understand these bearish breakers and bullish breakers, because what you just have to know even about us professional traders or profitable traders is just that we are in the same market, but we see things differently. So once you see things differently, that means you can do what other peoples are not doing, because the market makers are very very smart. They know whatever they are doing. They are very very smarter than us. So guys, it's very much important to understand these key levels, and it's very much important to understand where do we enter, and it's very much important to understand why are we entering the trade. So guys, there are people who just enter trades without even knowing. So if you enter a trade while knowing, even if the trade it is at loss, you know the reason why your trade is at loss, then you will just have to take out your trades, or you just decrease your lot sizes. Decreasing your lot sizes, this is what I mean. Let's say if you are trading with with 10 lot let's say with 0.10 lot sizes. That means if your trades are in the losing size, you will just have to take down 8 trades for you not to take huge losses. That means if you are a professional, you can know that the market once it takes you to 30 minutes losses, that means your direction it is incorrect, and you'll just have to understand that the market, if it takes you to even 15 minutes losses, that means you are not safe. So it's different on the type of trader you are. So it's very much important to know what kind of a trader you are, or what type of a trader you are, because there are too many types of traders. There are traders who can hold a trade for the whole month, and there are traders who can just take a trade for a minute or 5 minutes. So it determines on your balance. Your capital determines on what type of a trader can you be. You cannot just expect to open a weekly trade with $10, but sometimes it is possible to enter it with $10 while you know that you are going to enter in the right spot. So that is what matters most. But holding trades for many days without experience, that is what is going to take you to more losses. So let's continue with the bullish breaker. The bullish breaker, it is made of high, high, lower high. So high, lower highs, it's a bullish breaker. So its key element is low. The market is going to start at low point, at a low point or a lower point, at a low point. So how do you know that the market is about to start? The market, while the market is about to start, you will it you will just have to know that the market starts at support and end at resistance. That is what the market does. It starts at support and end at resistance, or it can start at resistance and end at support. If it starts at support, that means the market will be buying. If it starts from resistance, that means the market is going to be selling. So I hope we are clear with that. So resistance simply means supply, and support means demand. You don't have to forget demand and supply rules. Demand is support. If the price is on demand, that means the price is at lower low. Lower low. So the key elements of bullish breaker, you can take them down. These are the key elements. Right low. High is the second one. Higher high is the third one. Lower low is the third one, and higher high is the fourth one. Higher high is the fourth one. Sorry for. So how does these things work? This is how it works. Once the market is at higher high, we expect the market to create higher low, and higher low is our entry. Once we know higher low, That means we know how to buy. If you want to know where to buy, you it's where higher low is at. So we don't have to buy because the trend is going up or you see the trend up, because sometimes most people they don't understand that the institutions they move market fast or faster than we know. We'll have to know that. So while we are talking about the bullish breaker, the higher high is the key. The closure above indicates price want to continue higher. So you don't have to forget that once the price breaks on a bullish breaker, just know that the price is saying that I breaked now. After breaking, the price will have to retest. After retesting, the price will create a higher low. Where the higher low is at, it's in the middle. It doesn't, you won't even know, but the higher low, it's it's on the same place with the high. If you get the higher or the higher of the previous day, just know that you are going to get the entry. So let's continue with the bullish breaker. You don't have to get yourself confused. A bullish breaker sometimes can happen in a bullish range or close up in candle and the most recent swing. So you will just have to understand what is swing. If we are talking about swing high or swing low simply means the lower low. Swing low is the lower of the trend. Where the trend begins, it's what we call a swing low. Where the trends end, we call it a swing high. You don't have to confuse yourself. You just have to understand that the market is made out of many time frames. There are too many time frames. Like even if you can see the 1 month time frame, you don't see the 6 month time frame. So that is what you just have to understand. So it's much important for us as traders because we cannot wait for an 1 year trend or a 6 month trend. What I am trying to say is that us as traders we can use a monthly trend or a or we use a weekly trend and or we use a 4 hour time frame or we use 1 hour time frame or we use 30 minutes, 15 minutes, 5 minutes and 1 minute. So you will just have to understand that these 15 minute, 5 minute and 1 minute, that are the most important time frames. If we are talking about the 15 minutes time frame, the 15 minutes time frame, if you are using it or if you are taking a movement that is happening in a 15 minutes time frame, you will just have to know that it can take a day, the whole day, for the market to complete the 15 minutes time frame. So the what what's very much important in knowing the time frames or differentiating the time frame is that if you are using a 15 minutes time frame, just know that the market or the stop loss of your market is gonna be low, it's gonna be small. You are going to use a small stop loss. But if you are taking a daily time frame, you'll just have to know that even the stop loss is gonna be huge. So that is what important, and you will just have to respect that. We don't choose our own stop loss. We don't choose where we want to put our stop loss. It's not possible. So you will just have to understand the reason why we put the stop loss. So if we are taking this trade, that means the stop loss is supposed to be at low, and we target the potential high. So there's something that is called a potential high and a potential profit. So potential profit is it's when, if you want to know the bullish potential profit, you get it on the bearish older block. So you will just have to understand the older blocks and how they works, and the higher and the lows of the market. So before we stop our lesson with this topic, we can just have to make this clear, or we can just have to let you clear if you don't understand about how the bullish breaker works, or why does a bullish breaker occurs, or why does it happen. If the bullish breaker happen in a market, just know that the market created a low, and the low, after the low it created a high, after the high it created the lower low, after creating the lower low must be lower than the low. You have to differentiate the difference between the low and the high. So the lower low must be down compared to the low. So after the market creates the low, the market will try to go up, will have to go and break the high, the previous high that the market created before creating the lower low. It's going to be broken, then the market will now create a high. When the market create a high, just know that the market is about to go up. It's going to buy. We wait. If there is a bullish breaker, that means we wait for retest. Once the market retested, we look for our entries. As simple as that. In any time frame, that is what